are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. Okay, and by the way, during this webinar, I'll try to answer I'll leave the question box up, so if you have questions along the way, I'll try to answer them. If you have a question I can't answer, or you have to leave and want to leave a question, please leave your name and your phone number in the chat box or in the question box, or your Skype username if you want to Skype. Rory he's a tech trader and an administrative guy at Brightline. He'll call you back and he'll answer any questions you might have. He can give you a lot more details than I can about specific questions about some of the offers and things we have, but we'll cover all of those. But anyway, or you can call them at 786-732-4656. All right, so that's just kind of a little bit of busy work here. All right, so this is just a graphic that shows the SPY super system, or the Compass system. This is what the Compass system looks like. We'll go over quite a few of these charts, but the Compass system, what it does is tracks institutional money flow, which, as I'm going to explain, is the most critical thing to become a consistently profitable trader, is to trade with the institutions and don't try to trade against the institutions. This, by the way, is what the alert service looks like. It comes out on your phone. I send it when I find a trade we're going to take. I send out an alert, and it gets you pretty quickly. I'm on the alert service, so I can judge how much time it takes. It takes about 15 seconds from the time that I enter the alert for it to get to my phone. So again, these are trades that you can take if you're not in the room, or you don't want to be in the room, or you're working, or whatever. This gives you the opportunity to do that. All right, so the first thing I want to cover, and I cover this in all my webinars, so if you've been to any of them, this is going to be redundant. But this is really an important concept. It's really important to understand that the stock market, what moves the stock market, it consists of many, many small retail traders, and this is the retail traders right here. These are us. I'm a retail trader. Most everybody here is probably a retail trader. And it's important to understand that we as retail traders, we cannot move this market. We don't create trends. We can't stop trends. We can't do anything. So when we're just trading, when the institutions aren't in, when retail traders alone are trading, what you get is a lot of chop and a lot of chaos. And it's pretty unlikely that you're going to make any money when you're just trading with retail traders here. This is the institutions, and let's talk a little bit about what are institutions. Most everybody knows things like Goldman Sachs, JP Morgan, Morgan Stanley, HSBC. All the big investment banks are part of the institutions. They have billions of dollars to invest and to trade. And investment banks also have programs called algos, basically computer programs that look for specific conditions in the market or specific news, and they trade off of those. And about 80% of the trades that go through the market now are algo trades. So there's no humans pushing buttons. The humans are writing the programs, but they're looking for specific criteria. So that is what it makes up a lot of the institutional trading. But think about things like hedge funds, hundreds of hedge funds with billions of dollars to trade. That's part of the institutions. So our mutual funds, T. Rowe Price, Vanguard, really huge mutual funds, tremendous amounts of money, tens of billions of dollars to invest and trade. And then you have things like the firemen and police and state workers that are in pension funds. Those are also part of the institutional money. So our job as retail traders is to determine when the institutions, all of them together, are moving a trade up or down and trade with them. If they're not in the trade, we don't want to be there. And if there's institutions in there, one institution is trading one way, another one's trading another way, the Compass system will identify the fact that there is no overall institutional investment going on right then in that trade. And it'll show us that we don't want to trade it. All right, so that's what we're looking for. What we're going to do is we're going to try to find when the institutions are in the trade, and then we're going to trade and take money from the other retail traders who don't know what we know. They don't have as good a software as we do. They don't have the knowledge we do. And this is where we take our money from. Okay, so again, institutions are what we want to follow. So in the room and on the alert service, I have a couple of pretty basic rules. First thing is we trade what's called trade the best and skip the rest. And this sounds simple, but we're only taking the various highest probability trade setups we can find, and then we're skipping all the rest. So we're not taking a lot of trades. It's important to have patience when you're trading. You don't want to be taking trades just because you want to take a trade, you know. And this is the second rule. Our objective is not to make trades. Our objective is to make money. And this is kind of an important concept, because a lot of traders, if they're online and they've got their platform up, they feel like they've got to be in a trade all the time. So they'll get antsy, you know. They'll have FOMO, they'll have fear of missing out on a trade, they'll be jumping in a trade, and they shouldn't be. They're in low quality trades, but just to really want to be in the trade. So that's our objective, is not to make trades. Our objective is to make money. So we need, as a profitable trader, we need an edge over other retail traders. And somebody says, why is your sound muted? I don't know. My sound should be. Is everybody's sound okay? I got my mic turned on and it should be fine. I don't know why, John, where your sound is muted. No idea. It sounds good, Steve. Yeah, most everybody else is fine. You might just try logging back in again, John. All right, so our edges as over other retail traders is we have the Compass system, which I'm going to show you. This is the piece of software that identifies when institutions are in trades and when they're not. We also want to trade what's called relative strength and relative weakness. Now, don't get this confused with RSI, which is a relative strength oscillator, relative strength index. I don't use it. I don't think it's any good. But when we're trading relative strength or relative weakness, what we're doing is we're looking to see what the stock that we're looking to trade, how it's performing relative to what the S&P 500 is doing on that same chart. Like on a 5-minute chart, if your stock is moving up, green bar after green bar, and the SPY is moving sideways or down, then you've got relative strength. And that gives you an additional edge with a trade, because if the market just goes against you, your stock is not going to go against you as much as the market is, because it has relative strength to start with. And that's also true for relative weakness. That's how you would take shorts. We do want to trade with the market trend. We're not going to counter trend trade, and that would be for a 5-minute chart or a daily chart. All of my trades, by the way, I start with the daily chart first. So when I take a trade, the daily chart, if I'm going long, it has to be bullish. I'm not going to take a stock long if the daily chart is bearish, because I want to be able to stay in the trade the rest of the day if I need to, or overnight, or for a few days. And the only way I can do that is if I take a stock long, if the daily chart is got a bullish setup on it. So that's what the trading with the market trend means. And then the fourth thing is we want to try to buy near support and sell near resistance. So it's important to not chase stocks when they're moving up and moving down. We want to wait for the stock to come back to or go up to a support or resistance level, and then revert back into the original trend. And that's where you want to get in. It gives you a much better risk-reward ratio, because your downside risk is reduced by a lot when you're coming in near support or near resistance. All right, now the Compass system itself is a piece of software that I have installed on my thinkorswim platform. Anybody can buy it and have it installed on the thinkorswim platform. You don't have to have you don't have to pay for thinkorswim. You can get a thinkorswim platform and have the software installed on it, but you don't have to trade on thinkorswim. I trade off of a Tradier using TradeHawk as the front end, but you can trade off of any platform any trading platform you want. You know, you trade off of Tastyworks, thinkorswim, Fidelity, Scott. You can trade off of anything, but the software is going to run on thinkorswim to give you the information that you need to determine if institutions are in the trade or not. Okay, so it identifies the highest probability trade setups while sidestepping setups that look good but will fail more often than succeed. In other words, trade the best, skip the rest. It does this by identifying when institutions are driving the move and when they're not, and we'll get into a little later exactly how it determines that. Now, it also analyzes complex trading data and displays the results in an easily identifiable visual format. And this is really important, because to really know if a stock is bullish or bearish, if you're trying to read price action, it takes quite a bit experience and knowledge to be able to do that. With the compass system, the fact that it's being displayed in colors, even new traders are going to be able to identify high probability trade setups or bad, low quality trade setups fairly quickly. And we'll show you that. So again, this is how we get an edge over the retail traders. We only take trades that are being driven by institutions. I keep repeating this. This is really important. Trade stocks that have relative strength or relative weakness, and trade in the direction of the overall market. Those, if you follow those three rules, you're going to be ahead of 95, 96% of the retail traders. Most retail traders don't know if these institutions are in the trade or not. They don't have the ability to determine it or the software to determine it. They don't even think about relative strength or relative weakness. And some of them, a lot of traders will try to trade in the direction of the overall market. But these first two things, most traders don't even have any idea. So again, our trades will be supported by institutional buying or selling. We're only taking the trades that the institutions are pushing. The stocks will be outperforming the index, like the SPYs or the Q, and they're going to be moving in the direction of the overall market. These are what gives us an edge over retail traders. All right, so this is just something, and I want to just kind of go over how I find trades, where the trades are coming from. This is what I call a basic high probability trade setup funnel. This is a virtual funnel. Basically this is the thought process I go through when I'm trying to find a trade. So the first thing is I look at the daily chart to make sure if I want to go long, make sure the daily chart is bullish. If I look at a stock and it's moving up on the 5-minute chart, but it's bearish on the daily chart, I'm not going to take it. I have to have a bullish daily chart to go long, a bearish daily chart to go short, and then I want the 5-minute chart to align when I enter the trade. So if I'm going long, I want obviously the daily chart to be bullish. Then I want the 5-minute chart to also be bullish. Again, we're going to trade with the trend, both the stock and the market. And then we go and we take a look at the compass indicators on the trade that we're considering. If the compass indicators are telling us that the institutions are buying this, in other words, the institutions are bullish and we like it bullish, then that passes that test. If we like it bullish on the daily chart, but the compass indicators tell us that it's either neutral or the institutions are bearish on it, we scratch it. The trade is, we're not going to take it. So if we pass that one, then we take a look at relative strength and relative weakness. We want to take the stocks with the best relative strength for long and best relative weakness for short. And then the last thing we look at is whether we're near support or resistance. So these particular probability criteria is what determines whether a stock is going to be traded or not. When it drops out the bottom here, then it becomes a prospect. Then we have to do some more technical analysis on it. Now, if you like a stock and everything is met, but it's not near support or resistance, what I usually do is on my, I use TC2000 as well for my charting. I put an alert on there to let me know when the stock hits or gets close to that support or resistance level. All right, so that's the trade setup funnel. This is when a trade is a high probability trade, this is where it comes from. And this is just basically the funnel method. This is just written out. The key things here is the stock to be traded should have the daily and 5-minute chart aligned, and the compass indicators must align in the direction of the trade. Those are the two key things. Then we talk about support stock should have relative strength to relative weakness. Again, if you're following these three criteria right here, you're way ahead of almost all retail traders. They just don't know this. Now on the 5-minute chart, there's one key indicator that I use called the VWAP, the volume weighted average price. This is an indicator that all the institutions use. It's typically where they go long and short is around the VWAP. So when we're using the 5-minute chart, we're not going to be long unless the price is above the VWAP. We're not going to be short unless it's below the VWAP. That's kind of a key level that we use. All right, and the most important thing, and I stress this every day in the room, is you have to have patience. And this is really a hard thing to do for traders. Again, as I said, our objective is to make trades, is to make money, not to make trades. So if you're just making trades just to make trades, then you're basically negating the patience. You've got to be able to sit there and watch the market to find these trade setups. All right, so in the room and on the alert service, this is kind of a recap of the trades that we use, the methodologies that we use. Obviously, we do straight calls and straight puts. That's probably 65–70% of the trades that we do. I also do debit spreads using weekly options expiration. In other words, if I do a debit spread this week coming up, if I do a debit spread on Monday and Tuesday, the expiration date is going to be Friday. And a lot of people don't do this, and they don't understand that your ROI on a debit spread with weekly expirations is much better than it is if you go out 2 weeks, 3 weeks, or 4 weeks, because of the fact that your short option, the option that you sell when you do a debit spread, deteriorates a lot faster on the weekly. Obviously, the time decay is faster. So that's why I use weekly options expiration. And this has been, I've proven this out over and over again in my trading platform, where I load my trades into a program that I use to analyze it, and that's how I actually found it. We also do something called time spreads, which are actually calendar spreads. We do time spreads over earnings. Now these are that's a non-directional trade. This trade is non-directional. We don't care if the stock goes up or down after earnings. We just care that it stays within the range of what the market makers are expecting. So what we do how we're making money on this is we capture what's called the volatility crush. Before earnings, the option premiums are jacked up by the market makers to cover themselves, because they don't know how much the stock's going to move, and they don't know which direction it's going to move. And we take advantage of that with what's called the volatility crush, or a time spread. We just did one of these this past week. We just did this on Thursday on ALLY, which had earnings on Friday morning, I think. And we made 45. I made 45% on it. Some of the people in the room made over 100% on this. I had an order to close it out, working when the market opened. Some folks stayed in, and they were able to grab over 100%. But we do these, and we have really good success with these. This is actually a good time right now, because we're just going into earnings season. Earnings season is just started, so we'll have quite a few time spreads coming up. And then I have another strategy called the weekly ATM strategy. This captures premium by selling puts against a neutral to bullish stock. We do that week after week after week, and we hold a longer term dated long put to protect ourselves. And I've got a video on all of these strategies. And then we do credit spreads to capture premium. We're in a credit spread right now on Crowd, CRWD. And the last thing I want to talk about is this, what's called the SPY super system. This is a system that we do for very high probability trades to catch the SPYs, the Qs, or the IWM on 5-minute charts. And I'm going to go over some of these. I do this in the room. I can't alert on these. These are very quick trades. I typically will mention in the room that there's one set up and I'm taking it, or there's one set up, and other traders will then use it. A lot of people use this, the SPY super system now, that are in the room, but you have to be in the room to actually use this, or you have to have the Compass system on your own machine that you can trade off of. But this we're going to go into some detail on. It's very successful, and as I go over the results that we've had, I'll keep in mind that the results for the SPY super system are not included in my regular room results. They're separate, and I'll show you those separately. All right, so let's talk briefly about the Compass Alert Service, who it's for. For one thing, it's designed for day trades and short-term swing trades. These trades are mostly going to be the same day, in the morning, out in the afternoon, or short-term swings. And short-term swings, to me, means anything from overnight to maybe 3 weeks. That's probably the longest. Sometimes I'll go a month. It depends, but typically a few days is going to be what most of these trades are going to last. Again, it's designed for traders who can't watch the market all day or don't want to watch the market all day. The real-time alerts will be on the highest probability trade setups. So the trade setups that I find are going to high probability, when you get an alert on them, it's going to be one of the high probability trade setups that I've identified, and I'm taking that trade, and then we're taking it in the room as well. Now, the way we find these high probability trade setups is by identifying institutional involvement, which we talked about. That's the Compass system telling us that. And then I look at market internals, which is basically the volume of stocks going up minus the volume of stocks going down, to see if you've got a bullish or bearish market internals. And then I do some technical analysis on the individual stocks to find the best one. So that's what the alert service looks like. This is an equity curve for the alert service. This is like from March 23 to June 24. So, you know, I guess 12, 14 months. But it just basically wanted to show what the equity curve looks like. Again, it's bottom left to top right. And this is based on $2,000 per trade, putting $2,000 into each trade. Okay, and again, we have some losses. You see this little dip here and a dip here. We have some losses from time to time. But overall, the performance has been excellent. All right, so before we go any further about the results I've had, I want to spend some time on options because I know a lot of people came here just to hear about options. So I want to put this up fairly early in the webinar. So we're going to talk about options. Now, first thing I'm going to show here, and this is probably really basic for anybody who's traded options before, but anybody who's not and is trying to learn about options, this is what's called an option chain. And this is from March, but I use the same thing because the information is the same. This is on Bristol Myers, and this is what an option chain looks like. The left-hand side are calls, and the right-hand side are puts. So these are the calls, and these are the puts. This is the expiration date. So Bristol Myers has weekly expiration, so you can see they have an expiration every week. So you're going to pick an expiration date that you want to buy an option for. This is the strike price. This is the strike or the price of the stock that you're looking for it to be at when for your option is concerned. So this is the strike price. Now, if you look at Bristol Myers, it's trading at 53.79, and you see here this shaded line. That's 54. This is what's called at the money. This is considered an at the money option. That's the option that's closest to the actual price of the stock. So it's 54, right? And this is what's called the bid, and this is the ask. So the bid on this is 61 cents, or $61 a contract, and the ask is 66. So you've got about a $5 spread between the bid and the ask. All right. So this is what, if you bought this, you're probably going to end up paying somewhere around $63 to $64 a contract, somewhere in the midpoint of that. And now other thing that's on here that's important is this is delta. The delta is this number right here. And this on the 54 calls, you see the delta is 52. What the delta does, and I'm going to get into this a little bit on the Greeks, delta tells you if the stock moves up $1, how much is my option price going to go up? If the stock moves up $1, the option price is going to move up 52 cents. All right. Now, if you notice on the puts, as the stock price moves down $1, the puts are going to go up in value by 48 cents. And you notice that the delta on the puts and calls and the puts adds up to 100. It always adds up to 100. Dave, what broker provides this chain? All the brokers, these chains are going to be the same. I think this came from I'm not sure if this came from Tradier or Thinkorswim, but option chains are all the same. The information is basically going to be the same. You know, you always have calls over here, puts over here, strike prices down the middle, and expiration dates across the top. You just click on them to come up with that. Now, one of the things here that I want to notice, this is called an at the money option when it's close to the price of the stock. If we move down in price, you see the 53s and 52s, 50s and 52. These are called in the money, and these are in the money because the stock price is higher than what the strike price is. Right, so these are in the money calls, right? But they're out of the money puts. And you notice that as you go deeper into the money, that the delta keeps going up. 52, 71, 79, 85. So if you took a $52 call on Bristol Myers, well, first of all, if it's trading at 50, almost 54, you've got $2 of intrinsic value built into that thing. And the delta is 85. So every dollar the stock moves up, the option price will move up 85 cents. So that's important to understand. These are called out of the money calls because the price of the strike price is higher than what the stock price is at. So the stock price hasn't got there yet. So these are less likely to make money because it's less likely the stock price is going to get there. So you notice that the delta goes down on these. So if you take a 55 call, if the stock moves up $1, your $55 call is only going to go up by 29 cents. Versus the $53 call is going to go up by, with the $54 call is going to go up by 52 cents. So you see that the deltas drop. All right, so that's how they work. The puts are exactly the opposite, of course. Out of the money puts would be this side up here, because the stock would have to drop more than it is, and these are in the money puts because the stock price is below these prices already, and you can see they're reflected in the delta. All right, so that's the basic option chain right there. One other thing to know about in the option chain is that there's a thing called OI and vol. That's open interest in the volume. This is relatively important. It tells you how many contracts have been purchased or sold that day, and how many there were at the beginning of the day, how many open contracts were open. So this shows, like, on a $50 call here for Bristol Myers, the 617 $50 calls that were either bought or sold during the day. Pretty high volume. And there was 11,867 open interest at the beginning of the day. This tells you there's a lot of open contracts on there, which means it's very easy for you to get in and out of a trade. Now, the thing important to understand, this 617, which is the number of contracts that were actually traded today so far, is not included in this 11,867. This is always reset every first thing in the morning to show you how many open interest there was that day. So, you know, if things were sold, that's going to reduce the open interest, and if they were bought, that's going to increase the open interest. But this won't be reflected until the next morning. All right. So that's your option chain: calls, puts, strike prices, and expiration dates. All right. So what we're going to talk about as far as options are concerned here is a few things here. What are options? Well, basically, they're derivatives of the stock. We're going to talk about what makes up the option premiums. We're going to talk about intrinsic versus extrinsic value. This is pretty important. We're going to go into the Greeks a little bit. I'm not going to go into every Greek, but the ones that I feel like are useful to trade options. Strike price and expiration date, we've already talked about. The volume and interest, open interest, we've already talked about. And then I'm going to go over the primary option trades that we take in the room and on the alert service. All right, so we're also going to give you a list of, if you're bullish on the stock, what the bullish option strategies are that you could use. There's several of them. Same thing on bearish. If you're neutral, what option strategy you can use for neutral. And then I'm going to talk a little bit about the trade setups on each one of the option strategies that we can use. I'm not going to go into a lot of detail on this. I have videos on all of this stuff. So, but this can get fairly complex. All right. So what are options? Well, options obviously are derivatives of stocks, and there's a couple of things to understand. You have calls and you have puts. We've talked about that. All options are made up of calls and puts, or combinations of those. And they come with what's called rights and obligations, right? So if you buy a call, let's take Microsoft, for example. Microsoft's trading at 100. If you buy a $100 call on Microsoft, that gives you the right to buy the Microsoft stock at $100 anytime up until the expiration date of your option. So if you buy, you know, on November 25th, $100 Microsoft call, you have a right to buy the Microsoft stock at $100 a share up until that option expiration expires. So that gives you the right. Now, you don't have to do it. Most people don't. What most people do, if they buy the Microsoft $100 call, and the Microsoft stock goes up and the call goes up, let's say you pay $5 for it, and it goes up to $7.50, they just sell the call and take the profits. The other thing that's kind of important is the obligations. If you sell a call or you sell a put, you're obligated to take ownership of the stock, either long or short, if it's assigned to you. So that's really, it's important to understand that. And if you sell a put, you sell a Microsoft, let's say you sell a Microsoft put, Microsoft's trading at 100, and you sell a $95 put on Microsoft. Basically, you're trying to collect a little money, and you don't think the stock's going to fall down to 95. And if it doesn't fall down to 95 or below by the time your options expiration comes along, you keep the money that you got when you sold it. But if it falls below 95, let's say it falls down to 90, and the person that bought that put from you is going to exercise it or can't exercise it, which means you are then obligated to buy that Microsoft stock back at $95. So you're basically going to have the stock assigned to you. It's going to be short multiple, like 100 shares at $95, and you'll have to turn around and buy it for 90. which is what it's at. So you're going to lose $5 on it. So just know when you short a put or short a call, you're obligated if anybody goes ahead and sells those or exercises those once you sold the puts or the call. So you've got to be very careful when you're selling calls and puts. I would recommend never selling naked calls. In other words, unless they're in a spread, never sell naked calls and only sell naked puts if you want to own the stock at a lower price. That's the only time you would do that, because anytime you sell a call or sell a put that's not in a spread, you're leaving yourself open to getting those shares assigned to you in your platform. All right, so you can buy or you can sell. Again, all option strategies are all made up of buying or selling. Russ, can stocks be assigned to you before expiration? Absolutely. Yes, they can. They can be assigned to you anytime. But typically, if you for example, if you sold a put on Microsoft at 95 and the stock was trading at 90 and it fell down to 95, it's very unlikely you're going to be assigned because of the fact that the person who did that is actually going to be taking assignment, but they're going to be down money because they had to buy the put, and the put is still going to be against them. So typically, it's got to move below the strike price that you sold at by more than what you actually collected when you sold that. So yeah, they can be assigned anytime. So when you buy, you were either long a call or buy or a put. You're buying a call and buying a put. That means you're long. That's the terminology. If you sell, you were short a call or short a put. All right. And again, don't do this unless you're doing it in a spread. That would be my rule of thumb on this. When you buy a call, it's called being long a call. That's bullish. You're bullish on the stock when you buy a call. When you sell a call, you're short the call, you're bearish. You're selling a call, like you say, if you're selling a $95 call and Microsoft is trading at 100, you're bearish on the stock when you're selling the call. Okay, so if you're selling a call, you'd be selling like a $105 call on Microsoft if Microsoft is trading at 100. You'd be selling a $105 call, so it's out of the money. You don't expect the stock to go up, so that you're bearish on it. And so buying puts is bearish and selling puts is bullish. All right, so those are what you can do with the options. All of the option trades are going to be made up of either buying puts, buying calls, or a combination of both. So the option premium that you pay for a option when you buy it, it's made up of a few different things. And options can be, as we mentioned before, at the money. $100 if Microsoft's trading at 100, $100 call, $100 put is at the money. It can be in the money. If you take a $95 call or a $105 put, those are in the money. And if you can take out of the money. So if you took if Microsoft was trading at 100, $105 call would be out of the money. Stock hasn't gotten there yet. So what makes up the option premium price? Well, it's obviously going to be made up of the stock price. Again, if we mention Microsoft again, Microsoft's trading at 100, and you buy a $95 call. All right, if you buy a $95 call and the stock's trading at 100, you've got $5 of value in that already because the stock is trading $5 higher than your strike price. So the option is going to be worth at least $5, and that's called intrinsic value. The $5 on the Microsoft $95 call when the stock's trading at 100 is called intrinsic value. Now, they're also going to add in premium on that. So besides the $5, you're also going to have to pay for what's called implied volatility. How volatile is that stock, and how much more are they going to add into that? The more volatile, the more money they're going to add to the cost of the premium for that option. And then the last thing is time decay. And time decay is how much time is there between the date that you bought the call and the expiration date. If you're going out a month, the time decay it's going to be fairly slow at the beginning. You're not going to have a lot of fast time decay, but they're going to add more time to the option because it's got much more time to get to the level that you want it to. So the stock price, the intrinsic value, is going to be the price of the option that's going to include the stock price. So again, if you buy a $95 call on Microsoft, when it's trading at 100, you've got a $5 value of intrinsic value. So your option is going to be $5 plus the implied volatility. Let's say that's another $1. So you're paying $6 for the option, and then there's going to be some time decay, and depending on how far out in time, that could be anywhere from $1 to $3. So when the stock's trading at 100 and you buy a $95 call, you might have to pay $6, $7, $8 for the option price, for the option of that price, and that's what it's made up of. All right, so it's important to understand this time decay, because we're going to talk about that a little bit more. All right, so again, that's what makes up the option premium. When you go in and you want to buy an option, that's what the market makers are putting on it. Okay, so again, we kind of covered this already, the intrinsic versus extrinsic value. Here I'm using a stock that's trading at 55, and we'll buy a $50 option. It has an intrinsic value of $5. So it's going to be worth at least $5. The extrinsic value is the option value minus the intrinsic value. So if this option I buy that has a $5 intrinsic value cost me $6 to buy it, then I've got $1 of extrinsic value that I'm paying for on that option, right? So if this is important to understand, if the option strike is out of the money, so on this stock, where we bought a $50 call on a $55 stock, if we paid a $60 call on a $55 stock, that stock is $5 out of the money. All of that premium that you paid for that option is going to be called extrinsic value. You have no intrinsic value at all, right? And this is really important, because when the implied volatility and the time decay drain out of an option premium, they're going to be drained out of the extrinsic value. So if you buy an out of the money call or an out of the money put, all your premium is extrinsic value, and that total money you paid for that option is going to be subject to the time decay and implied volatility reduction. So it's going to move down much faster, which is why I'm going to recommend we always buy in the money calls and in the money puts. And again, the volume of options traded at the strike price and expiration date is also important. The open interest, it just gives you, the more liquidity you got, the easier it is to get in and out of a trade. All right, so that's intrinsic versus extrinsic. Now we'll talk about the Greeks a little bit. We talked about delta already, all right? So to reiterate, how much the options price moves in relation to the stock price move. Stock moves a dollar, delta of 50 means the option price will go up 50 cents. You have a delta of 70, the stock moves up $1, your option is going to go up 70 cents. So the higher delta, the faster the option price is going to go up. But it's important to remember, the deeper in the money you go, the more the delta is going to be, the higher the delta is going to be, but the more you're actually paying for the option. Now there's another thing called theta, or time decay. And this is the decrease in value of the option as expiration date approaches. And this is not a linear thing. It doesn't go down by the same amount every day. The closer you are to expiration, the faster the time decay comes off. So if I'm out a month on an option, the time decay is going to be pretty slow the first week or two. But as you get into the week before expiration, last week, the time decay is going to accelerate. So time decay basically starts slow like this, and then curves down, and then really speeds up. So when you get to Thursday before 5-day expiration, your time decay is really rapid. And the last one here we talk a little bit is called gamma. The gamma is the rate of change in delta. So when a stock price moves up and your delta is 50, it could move to 52 or 53, or it could move to 56 or 57. The difference in how fast that delta moves is called the gamma. And a lot of that has to do with the volatility. A stock that you buy in the morning that's moving up really quickly, the gamma could be high. The option price could go up really fast because the implied volatility is cranked up. And then when the implied volatility starts to slow down, if the stock goes sideways, the gamma will go down and the rate of change in delta will be reduced. So these are the main Greeks that I look at. I don't worry too much about some of the other ones. Okay, so the primary option strategies that are out there, and I'll tell you the ones we use and we don't use. We're long calls and puts, and we use a lot of these. We do put credit spreads, are called credit spreads. This allows us to create a spread buying a call and selling a call, or buying a put and selling a put, and collecting premium, collecting money on it. So we do put credit spreads and call credit spreads, and put debit spreads and call debit spreads. These are spreads that we actually end up paying for. That's why they're debit spreads, and these are ones we collect money on. These are called credit spreads. We also do calendar spreads, and this is what I call time spreads in the room. Time spreads allow us to capture what's called volatility crush over earnings. This is a non-directional strategy. Calendar spreads are non-directional as far as the time spread is concerned. We don't care which way it's going. There's other strategies that people use called condors or iron condors. I don't use these. It's basically selling a put credit spread and a call credit spread on the same stock. You're looking for a stock to stay in the range. It's basically looking for a stock to stay within a certain area. There's another one called butterflies. And lots and lots of different strategies on butterflies. Again, this is you're trying to identify what exactly the price of the stock is going to be at expiration. And then I do strangles and straddles. These are non-directional trades that are looking for big moves in the stock, either up or down. And we'll go over exactly what the difference is, but these are very, very similar. All right, so this is kind of the strategies that you would use option-wise. If you were bullish on a stock, you can either have long calls, you can sell puts, not recommended, you can do put credit spread or a call debit spread. These are all bullish option strategies. The bearish option strategies, you can be long puts, short calls. Please never do this. Please don't sell calls short, what's called naked. You can do them in spreads, but don't ever sell them naked. You basically open yourself up to completely undefined risk. The risk is massive when you do these short calls, selling the calls. Or you can do call credit spreads or put debit spreads. All of these are bearish strategies, right? That's really important. One of the things I'll mention is all the strategies we do in the room when we take a trade, they're called defined risk, which means we can't lose any more money than we put into the trade. When you do a short call, you certainly can. You're collecting money and you can lose way more. You can wipe out your whole account with short calls. But on all the trades that we do, anything that I alert on, your risk is never more than what you actually put into the trade on these trades. If you're doing a debit spread, a credit spread, your risk is exactly the difference between the two strike prices. So minus what you actually collected. So they're all defined. Now for neutral strategies, if you're neutral on a stock, you can do condors, which again I do not do, straddles, strangles, and time spreads. And time spreads would only be over earnings. This is to collect volatility because there's no volatility crush to collect if you're in between options, in between earnings dates on a stock. But these are neutral strategies. So this is good to keep in mind. If you look at a stock and it's bullish, you can say, okay, which one of these is going to give me my best return on investment? That's what I look for all the time. When I like a stock and I go long, I've got to decide which is the best way for us to take it. Right? Do I take long calls? Do I do credit spread? Do I do a debit spread? And you can even buy stock. I mean, if the options are crummy, you can go ahead and just buy stock. All right, so those are the strategies: bullish, bearish, neutral option strategies. These are the setups we're just going to cover real quickly. For put credit spread, which you're actually going to sell a put and buy a put at a lower strike price and receive a credit. And I have videos on all of these strategies and this proper way to construct them. We do call credit spreads. We sell a call and buy a call at a higher strike price and receive a credit. Put debit spread. You buy a put and sell a put at a lower strike price price and it costs you. That's the debit. And for a call debit spread, you buy a call and sell a call at a higher strike price for a debit. Right? So those are the spreads that we use. Calendar spread, I talked about already. You sell a put or a call at a near expiration date and buy a call or a put with a later expiration date. So what I do on time spreads is I sell this week's call. If earnings are going to happen, let's say earnings are going to happen on Tuesday, I'll sell this week's call on Monday to take advantage of that, and I will buy next week's call. So I'm selling a current week's call, buying next week's call to take advantage of that. And that's how we make money on time spreads. We're collecting money on the volatility crash. We're also collecting money because this week's call decays faster than next week's calls. All right, and then we get strangles and straddles. Strangle is you're going to buy a call, buy a put, for example, a call and a put one strike or more away from the money using the same expiration. So if I was doing a strangle on Microsoft, I would buy a $101 call and a $99 put. So basically, one strike out of the money both ways because I'm looking for a big move, and I don't care which way it goes. I'm just looking for a big move that's going to cover my cost of the call and the put that I bought. And a straddle, if I was doing a straddle on Microsoft at $100, I'd buy a $100 call and I'd buy a $100 put, and that's going to give me my straddle. This is going to be a little bit more money because they're both at the money, but it's still the same strategy. You're looking for a big move up or down, one way or the other. And I will mention that you don't really want to do these strangles and straddles over earnings unless you're really good at technical analysis, because the premiums on the options are so inflated because the market makers don't know how far the stock's going to go in which direction. They increase the price on the puts in the call so that the stock would have to make a really outsized move for you to make money on a straddle or a strangle when earnings comes out, which is why I do time spreads on those. All right, and I know this is a lot of information to look at, but again, you'll have a copy of this. You can go over it again, and I have videos on all of these strategies in my room. Now, as far as choosing the best option, this is a rule of thumb, but you always want to use an in-the-money strike for a call or a put. Try to use an in-the-money one. You want on an expiration date, you want to go out at least 2 to 3 weeks, even for a day trade. If I take a day trade, for example, on Thursday, if I take one yesterday, on Thursday, and I'm planning on getting out of it in that day or the next day, I still go out 2 to 3 weeks, because if the stock moves sideways or down a little bit, I don't want time decay to be so fast that it reduces the cost of my premium, the value of my premium really quickly. So I'm going to go out 2 to 3 weeks to protect myself against time decay. You pay more for it, but it's going to, in the end, you're going to end up a lot better off because you're not going to get time decayed on that thing. And I always use deltas of between about 65 and 75. That is the sweet spot for buying buying an option, a long call or a long put. That's the delta you want to be around, 65 to 75. You can buy higher options. You can buy 80, 85s, and sometimes it's okay to do that. But I find I get the best return on investment with a 65 to 75. The higher delta, if you go up to 80 or 85, you're going to pay more for the option. I mean, your return on investment is going to be lower because you're paying more for the option. All right, so that's the best options to choose. In the money, always use in the money options and calls or puts. All right, so that kind of covers the options that I wanted to go over. I'm going to cover a review of this year's trades. And I'm not going to go over every one, but I just want to show what the results we've had. I'm very proud of the results that I've had in this room as far as the trading is concerned. But one of the things I want to emphasize is a lot of people go in to get emails and webinars all the time where they hear people talking about how you're going to make 400, 500, 600% on trades. It happens occasionally, but it's very rare, and you cannot develop a consistently profitable strategy trading that way. You're typically trying to trade way out of the money calls or puts, looking for a big move in the stock. If it doesn't happen, you lose all the value in the option. So what you're going to see here is typically our profits are going to run somewhere in the neighborhood of low as 10% up to about 50 or 60%. We did have 96% in Boeing here, but typically it's 25, 23, 65, 26. This is the kind of profitability per trade that you can expect, and you can also expect to have some losers. We have losers every month. This was January of 2024. We had 20 wins and 2 losses. 90% win rate. If you invested $2,000 in each trade, it netted about $7,500. Pretty nice for these. February, this was actually our best month of the year so far, I think. And again, this was the 24 wins and 2 losses, 92% win rate, little over $11,000 in profits in January. On the alerted trades, I actually broke these out this month. On the alerted trades, we had 20 wins and 2 losses. 2,000 invested in each trade, netted 69.30. So we can see had a fewer trades because I can't alert on every trade I take in the room. If I take in a trade and I expect it to be over in the next half an hour, I can't really alert on it. If I take a trade like 10 minutes of 4, I can't really alert on it because it won't get out in time for the folks. It's not fair for the alert service. All right, so that's February. The first quarter of 2023, investing 2,000 in each trade, taken in the room, produced a profit of 60,000. All right, and using an account of 50,000. I just point this out if you have a $50,000 account. When you started out using 2,000 in each trade, you were using 4% of your account for each trade. At the end of the year, the balance was about 110,000. So each trade would have only been using about 10%, 2% of the final account balance. These are just numbers. I have to have some sort of a baseline to go by. So I estimate $2,000 put in each trade. Nobody usually trades the same amount on each trade. I don't do that. I vary the amount of money I'm putting in a trade, and the key reason I vary it is how much confidence do I have that the market's going to continue to up. So on a trending day in the market, I'm going to invest more. On a choppy day, I'm going to invest less. On a trending day, I'm going to give the stocks more room to run. On a choppy day, I'm going to take my profits as quick as I can. All right. So, but I have to have some sort of a baseline. In first quarter of 2024, we did again 65 wins and 11 losses in the room, 18,000 profit, a little over. The alert service, 41 wins, 6 losses, 87% win rate, a little over 12,000. And yet the win rate's you're gonna see this over and over again, the same win rate. The profitability is obviously dependent upon what the market's doing at that point in time. Was it a trending market that month? Was it a choppy market that month? You know, August was fair. September was a terrible month because the market was so choppy. But you know, that comes with the territory. You can only trade what's out there. This was the second quarter. 65 wins, 14 losses, 83% win rate, 14,008, and the alert service 35 and 6, 85% win rate, 11.7. So if you add these up, you get 18 and 14. It's about 33,000. That's a little over $60,000 a year. It's very similar. We're right on track to match 2023's results in 2024. These were our May trades, just so you can see. And here's where some of the time spreads start to pop up, doing on earnings. We had a loss in BKE, but XP was a 71% profit, HPQ 50%, 30% here. And the time spreads actually generally produce a little higher return. Again, I had 45% yesterday in ALLY. They're a little bit higher than the normal trades on these time spreads. But you can see again, 20s, 18 here, 38 here. That's pretty close across the board. May we had 15 and 2, 88% win rate, netted 5,000. Options room 29 wins, 7 losses, 81% win rate, netted 5,700. Oh, I'm sorry, these were the alerted trades here. 49 and the room was 57. June, again, we had more time spreads, but I didn't put everyone on here. And again, notice that we have losses. It's important to understand that you're going to have losses. Anybody who trades is going to have losses. So in the option room, we had 86% win rate, 25 and 4, 75, 90. Alerted trades, 14 wins, 1 loss, 8,300. Made more in the alert trades in June than we did in the room. Not a lot, but still pretty nice. Here's the July trades. Again, you can see the consistency in the percentage gains we have here. And again, more time spreads. We had a loss on Bristol Myers, a win on JP Morgan, a win on Abbott, a win on Las Vegas Sands, and a win on WDC. Pretty nice month. Again, trading room, 85% win rate, 6,000 we've netted in the room. We netted 3,300 on the options on the alert service. Only 75% win rate. That's my lowest actually win rate since I started the business, since I started the room. All right, and these were the August trades right here that closed. I said so far, but this is all of them, I think, to look through here. But this is what we had: just 17 and 2, 89% win rate, 4,300 and 2,400 in the alert service. All right, so those are the results that we've had. I'm going to go into the super system too, so you can see. Remember, when these results you're seeing here, these do not include the SPY super system results. I keep them separate. Now on the alert service, as far as what you'll receive, you're going to get an alert for each trade that I put out. You're going to get the stock symbol, obviously the option strike price, the auction expiration date, and how much to pay for the option. And that may be, you know, $1.05 to $1.10 or something like that. And when I send it out, now if the stock really moves quickly, and it's when you get the alert, the stock's already gone up, I wouldn't chase it. I would set the order price for exactly what I have in the alert, and wait for the stock to pull back, because most of the time they will. Now, if it miss it and it keeps on going, then that's gonna happen. But basically, you're more likely to get filled at the price. You might even get a lower price if the stock pulls back. And when I'm going to give you an alert on the entry, and then I'm going to give you an alert on the exit. The exit, as far as we're either exiting for a loss, or we're going to go ahead and set a sell order and have the sell order working. So you would put your sell order in, and it would be marked good till canceled. When you put a trade in, you can make it good till canceled, so that if you're not at your machine in the morning, the option price, your sell price is still out there working, and you can get filled even though you're not there. So because a lot of times we'll sell these right in the market open. If we get like a gap up and we're long a stock and we're going to get a gap up, it's going to go ahead and meet our sell price. You don't even have to be there for that. All right, and I do put out multiple ones on the exits. If I set a sell price at $3 and then the stock looks like it's going to move up faster, I may set another alert out and say, you know, change it to $3.50 or something like that. All right, so just to go over this before I get into some of the charts, just so you understand how we get these kind of stunning results that we have. We are able to identify when institutions are driving a trade and when the market internals are heavily bullish and bearish. That's what we're looking for. When the trades would, we only take trades when both of these are in our favor. I have to caveat this. As long as the institutions are in the trade, if the market internals are neutral, I'll still take the trade. If they're bullish, I'm going to have higher probability. But as long as the institutions are in there and the market internals aren't against me, I'm going to take the trade. When they're both in my favor, that gives us even a better edge. So again, we take only trades and both these are in our favor. I just kind of gave you that caveat. That's where we get the trade the best and skip the rest from. How does the compass system identify when institutions are creating a trend? Okay, now it's looking at what's called a triple screen assessment. Triple screen assessment can be called fractal or multi-time frame, and that's what it is. And we look at three things. We look at momentum, and to me, this is the most critical thing. Momentum, and I'm going to show you why this is so critical. We use momentum, we use trend, and we use money flow, and we look at these across three different time frames. If I'm looking at a 5-minute chart, the compass system is looking at momentum on the 5-minute, the 15-minute, and the 45-minute. It's looking at all three of those. All three of those have to have momentum moving in the same direction, and I'll show you what momentum is in a minute, to be bullish. Same thing with the trend and same thing with the money flow. When all of these are moving in the same direction across three different time frames, the likelihood that the institutions are in that trade right then is extremely high, 96, 97, 98%. All right, so this is a graphic on the compass system. I just want to go over the indicators on here so you can see what they are, and you get to see plenty of these. But this is Thinkorswim, and this is my compass system on Thinkorswim. And so this is the compass chart right here. Now the key things that I'm looking at is these are the indicators. This is the long-term trend. This is the multi-time frame momentum right here, right? And this is the short-term or current time frame momentum. And this is a derivation of money flow, which I do not use much. But this is multi-time frame momentum. This is current time frame momentum. In order to take a trade long, you want the daily chart to be green or blue for the multi-time frame and current time frame momentum. And if the trend is also green or blue, that is even better. Right? In this particular case, we get green across the board. And this is a 5-minute chart on Tesla, right? And this is the compass system for Tesla. So these I'm using, these are my indicators. Again, multi-time frame momentum, current time frame momentum, critical information. Couple things we have on here. This is a 15 EMA. This little thin green line, 15 EMA of an EMA, it's a smooth EMA, right? And so it's one of the support resistance levels that I use. And this little shaded area is called the dynamic compression zone that the compass system puts out. And these pink arrows here are called pop signals, or pop out of the box signals. These tells you when the stock is breaking out of compression. These are great things for entries, for day charts, daily charts, and 5-minute charts for taking an entry. If you're taking an entry in Tesla, as the stock compresses and it comes off the 15 EMA right here with a pop out of the box symbol, this is an excellent entry as long as the daily chart is bullish. It's an excellent entry for long on Tesla, which we did take, by the way. All right, so that's what the compass system looks like. Now, the SPY super system is a methodology of trading the compass system on the SPYs, the Qs, and the IWM. All right, so we're trading off the SPY, Qs, and IWM. And the reason I did this was a lot of folks that were in the room have expressed an interest in, because a lot of times during the day I'm watching for trades, but there aren't any. I mean, we might put 1-2 trades a day on, some days none, some days 2 or 3, but generally there's a lot of what would be considered dead time where I'm just looking for, I'm answering questions, I'm posting charts for folks that are interested in looking at specific charts. If you're in the room, you can look at a chart and say, can you look at this one? I'll look at it on Compass, I'll look at it on TC2000 and show you my support and resistance levels and basically help everybody as much as I can. But a lot of people they can only come in for the room for a couple of hours, or they want to have some trades on. That's one of the banes of people is they want to have some trades on even when the market's not good. So what I did was I came up with the SPY super system because I had been using this myself before, and introduced it to the room, and I put a video out on it, and I've got a tremendous amount of interest in this thing. I have a lot of people in the room now doing the SPY super system and doing great with it. So I started it like mid-July to actually quantify it for the room. And so 2,000 invested in each trade produced about 25.96. Now some of these trades are going to be very short, all right? 1, 2, maybe 3 5-minute candles. They're not going to be long trades. They can go as many as 10 or 15 candles, but generally speaking, if the market's choppy, 2, 3, or 4. So a lot of these are going to have profits of $30 a contract, $40 a contract, $50 a contract, but the losses are going to be small because of where we're coming into these things. Typically losses of $10, $20, $30 a contract, and the good ones that run for us will go up $150, $200 a contract. So in August, we ramped this thing up. We had 56 wins, 6 losses, 2 scratches, 2,000 invested in each trade, produced 8201. Again, this is not included in the alerts, the rooms I told you before, the profits I showed you in the rooms. This is completely separate. And the September super system results, 40 wins, 3 losses, 2 scratches, 2,000 invested, produced 7132. Right, and a lot of it just depends on how many setups you get during the day. I had 2 days last week where I didn't have any SPY super system setups to take, so I didn't take any trades. But overall, you're probably going to have somewhere between 25 and 50 super system trades that are available. You don't have to take them all, obviously. So one of the nice things is with the SPY super system, you're in the room, or if you have the compass system yourself, you can do this yourself without being in the room, but you have to have the compass system to see the setups. With the SPY super system, you'll only have 1 trade on at a time, and they'll be very short duration trades. So I have a lot of folks that only can trade in the morning and the afternoon. So they'll come in like at 10 o'clock and stay till noon and then come back in like at 3. So if we don't have any regular alert type trades that we're looking at, but they may find one or two SPY super system trades in the morning and another one in the afternoon. So they come in and they can trade and make some money while we're waiting to find really good setups. So that's why I did this. It's really, really effective. So I'm going to show you one on the compass system. This is if you have the compass system. If you don't have the compass system in the room, it doesn't matter because I have the compass system up running all day long. This is what you're going to be looking at in my trading room. You're going to be looking at the SPY, or you're going to be looking at the compass system on Thinkorswim. Now this was one I took on 8-9. SPY super system trade, and this is when I put all the information on here so you know what you're looking at, because it looks real busy, right? But the only thing you're looking at is the compass, the current time frame momentum. All right, I'm not looking at any of these other indicators, just the current time frame momentum right here. Red to green, red to blue. Institutions selling, institutions buying. This is on the SPY, all right? So that's important. The other things we're looking at is this VWAP here, this pink line, volume weighted average price. That becomes our support or resistance level to trade off of. To go long as it goes above it, go short if it goes below it, or if the price is moved away from the VWAP, you can use the 15 EMA as a support or resistance level. So in this particular case, we had the price moving sideways. The current time frame momentum went from institutions selling to institutions buying. Pop out of the box above the VWAP, that's the entry. As the stock breaks above the entry, we've got institutions buying, stock breaking above the VWAP with a compression break. You don't have to have these pink arrows. The compression break, the move up would be fine. So we took it right here, and we rode this thing up here, and we rode it up here until we started getting these red candles, and we took profits right there, $220 a contract. This is a pretty big move. One contract, 220 bucks. In the room when I'm trading, I'm usually trading, 2,000 a contract, 2,000 a trade, but it depends on how much the option costs. But in this particular case, 10 contracts gave you $2,200 profit, and that's a pretty big trade. We don't get very many bigger than that, but that's a pretty good one right there. But I want you to see the setup here. Again, red selling, blue buying. The institutions sell, the institutions buy. So this is how the SPY super system is set up. This was another one here. This was on 823. This was a short on the SPY. These are all 5-minute charts. Here's the stock breaking below the VWAP, the volume weighted average price. This was our entry as it broke below the VWAP right here. Now it just kind of moves sideways, and my key here is it's below the 15, it's below the 8, below the VWAP. At this point in time, I'm going to make sure that the stock stays below the 15. If it goes above the 15, I'm going to get out. All right, so I'm watching it. It does never close above the 15. Went above it, came back. Went above it, came back, and then it breaks down right here, and we get out of this for $280 a contract. This was a nice flush in the compass system, in the SPY. And this, by the way, is called a pivot point. This is something I had to watch carefully because this pivot point can offer support to the downside or resistance to the upside. So I want to make sure it doesn't bounce here, but it didn't. It just fell right through it. Let me just get a sip of water here. Okay, so again, this is actually the same one we just looked at the beginning. Now this was on 823. This was on the IWM. IWM doesn't move as dramatically as the Qs do on the SPY, but you see this, see the VWAP, you see the stock just moving along it. Here's your current time frame momentum. See, it went from reds, institutions selling, blue, institutions buying, then it finally goes green. Now, the current time, the multi-time frame momentum was already green. I don't really care about that for this kind of a trade. I would for other trades, but not this one. So again, institutions selling, institutions buying, stock going along the VWAP, break above the 15 and the VWAP right there, right there on that pop out of the box. Buy it there and ride it up. We kept going. I watched it closely here. We got a red candle, but everything was still green. We were still above the 15, and then it took off again and moved up here. That's actually a pretty long trade, $150 a contract. That's probably about 12, maybe an hour worth of trading right there. But we get out right there on this red candle. All right. Oops. This was a SPY trade. Now I just want you to see the setups in these, just so it's clear to you what we're actually and how we're actually identifying these. All right. So here's the SPY. Here's a little pop right here. You see the red selling, blue buying, pop out of the box right to the VWAP. I don't take it there. I don't take it until it breaks above the VWAP. Right here is where I take the trade. Right there in that break above the VWAP. Everything's blue. The current time frame is blue. I buy it there and I sell it right there. That's about 4 or 5 candles. Again, this is another SPY trade here. Same thing. In fact, it looks like the same one. Oh, it is the same one, sorry. Here's the trade in the IWM. And this IWM here, there's a couple of opportunities getting in. You notice the current time frame momentum was green most of the time. It went to yellow a couple times. But, this could have been taken here and then just watched because it has to get above 15. I personally wouldn't take it here because it was too far away from the 15 and the VWAP. So I'd much rather wait for the stock to come back to the 15. which it did right here. You see how it came back to the 15 and it's still green here? This is where I took it. Right here is it breaks above the 15 with a pop out of the box. Now I had to watch carefully because this turned yellow, but then it went right back to green again. So I stayed in it and it stayed above the 15, and then I just rode this one up. And you can see it just kept on going. I think I got right up here as it stayed above the 15. And here's another SPY super system trade here. You can see this, all red, institutions selling. There's a break below the VWAP right here. Pop out of the box, you buy it. This is just a quick trade. You're gonna be short this, boom, boom, boom. As soon as you get this green candle here, you're out of the trade because it's gonna come right back. And these big candles can wipe out profits quickly in this thing. That's why it's key to get in at a level like this, like the 15 or the VWAP, and then use that as your stop. Again, another SPY trade here. Nice SPY trade on a breakdown. You see, we got green, institutions buying, institutions selling right here. This is where you can take it right there on that candle, right there as it breaks below the 15. Or you could have waited here, but you could take it right there. You don't need to pop out of the box. And then you just ride this thing down. You watch it carefully, and then once you've got your profits like you've got here, as soon as you get a little bit of reversal, you take the money right there. Notice it stayed yellow and red the whole time across here on the current time frame momentum. All right, and just another SPY trade. So I won't go over too many more of these. I think you can see here. Well, my throat getting I was sounding a little scratchy. Let me take a sip. So anyway, this is another SPY super system setup here, and breaking above the VWAP. You can see that. See, it's green, but I'm not going to touch this. I'm not going to take it here on the 15 because the VWAP is right here. Too much resistance. As soon as it breaks through the VWAP here, then I can take the trade. Okay, so that's the SPY super system setups. Before we wrap up, I want to go ahead over some of the regular trades we took for like the trading room and the alert service. And let's see, Richard, how to avoid pattern day trading if account is less than 25,000? You can't. I mean, well, there's ways to do it. I mean, you can have a cash account instead of a margin account. But if you're day trading, you got to have 25,000 or more. Now that doesn't apply if you're trading the futures. If you're trading, like, instead of the SPY, you're trading the ES, or instead of the Qs, you're trading the NQ, then it doesn't apply there. And you can trade those. I mean, I can set the compass system to have any indicator I want in there, any stock I want in there, so I can trade futures off of the compass system as well. Pattern there. Yeah, these are very similar patterns. All right, so I do want to show you some regular trades that we took to show you can see how these work. This is a trade we took very recently on Palantir. This is a daily chart on Palantir, and this is where we get into the trade. Notice how compressed it is here, but notice everything here is green, but then we went to yellow, back to blue, back to yellow. But here on this breakout right here, everything went green. Current time frame momentum, the multi-time frame momentum. And on these kind of trades, I need to have the current time frame and multi-time frame. On the daily, I need to have them both green or blue for long and red or yellow for short. And here's the breakout here. I don't use the VWAP on the daily chart. This was the breakout, and we stayed in this one for 2 days. Get in here, get out here on Palantir, and made 31% in 2 days. I think that was on one of my charts back there. And this was with Twilio. This was a nice profit on Twilio. This is a daily chart on Twilio. Again, I wanted both green. You see how this was yellow here, but the current time frame. You see the institutions here on the current daily chart of buying, but the multi-day chart, the multi-time frame, they haven't yet. But right here, they went green across the board, and I bought it right here, especially as it broke out of this compression area. And then we get out here in 2 days, 58%. It was really, Twilio was really a beautiful one. This is CRM, Salesforce. Again, you can see here that we had green here, and this was yellow. And actually, this arrow is off. It should have actually been here. Well, we took it and we get off here. But this is the same thing. We're basically looking for this break here. We took CRM. We get 29% profit in 2 days. Okay, and Lulu, this was a nice debit spread that we did on Lulu overnight. Did this overnight. We took a debit spread right here as it compressed and then broke down. We took a debit spread. See, this went blue, yellow, but it was kind of moving back and forth. Went to buying to selling. This was already selling. We took it here. Debit spread, 56% profit on this debit spread. Debit spread only cost us $1.92 or $192 and get out for $300. This was after the earnings on Lulu, which was weak, and then we watched compression, and then we got another breakdown on it. Workday, beautiful trade here. This was a 5-day trade, and again, this is a daily chart here. This was one here that actually I took here. I didn't take it here. I took it. The arrow should be right there. When this went to yellow to blue, and then it switched back to yellow again on multi-time frame. But the current time frame stayed blue the whole way here. So my concern at this point in time was that it didn't break down below the 15 on the daily chart, which it didn't. So we were in this thing for 5 days and made 30%. GCT in this thing for 2 days. This is a daily chart again. See the compression, breakout, green across the board. Institutions are buying, take it for 2 days, and we get out right here. All right. As soon as I see any momentum loss, we get out. GCT 26%. MDT, another nice one here. Again, selling, yellow. Institutions buying, blue. Buy it right here as it comes across the 15, and we ride it up. And we had this for quite a while. This is MDT. They're a medical instrument manufacturer. Was a nice move in MDT. And VKTX, same kind of setup here. Big gap up. This was a little risky because of the fact that I took it way up here, quite a ways away from the 15. But it was a really nice setup, and I had green across the board. And the profitability in this thing could be pretty high because there was such a good upside on it as far as the option prices were concerned. So we took 30% in 3 days on that one. All right, and here's McDonald's. This is an overnight trade. We get in for 8:30, out for 11:30, in right here, out right here, 37% gain overnight. Again, see the institutions are buying. We were very bullish, and they were bullish all the way through here. But this dynamic compression zone right here, the one that's shaded, plus the pop out of the box, gave me the impetus to take the trade because we were breaking out of this compression zone, and so we took it there and get out right there. And Amazon 32%. This is a 5-minute trade. This was a intraday trade. Again, the stock we got green here. Stock's moving along. I buy it right here on this pop out of the box as it comes across the 15. Could have actually bought it here. I just didn't like this yellow here. I could have bought it here, but this is where I took it. And 45 minutes up 32%. Nice move in that one, Amazon. And another one short. So you can see it works long and short. This was another nice trade in an ENPH to the downside. Again, compression, moving sideways, everything red. The institutions are selling. Here's my pop out of the box as it comes below the 15. Take it right here, stay in it for an hour, and make 20%. It did kind of flattened out. It wasn't really a great trade. They didn't have a lot of flushing down, but it did stay bearish the whole time. And Verizon, this was 50% in an hour. This was, if you were trading anything like Verizon and AT&T, the option prices are really tightly spread. They don't have very wide spread in them, and they end up being fairly cheap because the stock doesn't move that much. So in here we get in for 45 cents, $45 a contract for a short right here with an in the money put for next week. Get in for 45 cents, and we wrote it down for an hour, and we get out at 67 cents. So $450 for 10 contracts gets you out at $670 for 10 contracts in an hour. Pretty nice move on that one. And I guess this is just a SPY super system. This is before I actually started showing the SPY super system. This was a SPY super system trade right here, as you can see, coming off the 15, down it goes. And this was Tesla. This we take, sometimes we take them overnight. It's really important to take these things overnight if the setup is correct. Here we had red and yellow. So it was bearish across the board. I got a pop out of the box signal right at the end of the day on the 5-minute chart. So I liked it bearish. I took it overnight. We got a really nice break here because the stock gapped down. It dropped from 120 to 112. The option prices rocketed up, and we get out here. I think $750 a contract on the options. All right, so that was good. So again, it's important to remember that there's going to be losers. I'm showing you winning trades here, but there's trades that don't work, as I show you those in the results that we had. So some of them will they'll be a good trade, but they won't work. And what I always say is, if I look at a trade, if I look back at it and say I shouldn't have taken that, not because of what it did, but because of the setup, then that's a bad trade. But if I look at the trade and say, okay, it went against me, but I still would have taken it based on the technicals if I had to do it over again, then that's a good trade that didn't work. So there's a big difference between bad trades and good trades that don't work. You're always going to have some of those. Right. So again, it's very important to have patience and be disciplined. Listen, trading is a business. All right. It's a business. You've got to be disciplined like any business. You've got to manage it. You have to have money management. You have to have risk. You have to have risk criteria that you use. My trading is always done based on the technicals. If the stock stays above support, I stay in the trade. If it breaks down, I get out. I don't care what my P&L looks like. You shouldn't be trading off your P&L. P&L is going to make you trade emotionally. It's a big mistake to trade off your P&L. So I always trade just based on the technicals. And if the technicals break down, then I get out of the trade and take the loss. So again, these are the strategies we use. I talked about calls and puts, debit spreads, using weekly, the time spreads, which is over. These are capture volatility. These are non-directional trades, over earnings. Weekly ATM, which I have a video on, capture premium week after week by selling puts. Credit spreads to capture premium, and then the SPY Super System. So these are what we use in the room. On the alert service, all of these except the SPY Super System won't come out on the alerts. Okay. So I do have some offers for anybody who's interested in the room, the alert service, the room, or the Compass System. And these are pretty good deals. These are very good deals. The alert service quarterly for $396, annually for $992. And I've had some folks that wanted a lifetime. They didn't want to pay every quarter, every year, so they have a lifetime for $24.96 for forever. On the alert service. Now you also get, if you sign up for the alert service, you're going to get a month in the live trading room. You get it. We have a Discord and chat. You're going to get the alerts, obviously. With the Discord chat, I have 2 other professional traders that trade with me every day in the Discord room. They post charts. They post information on sectors. They post information on economic information. They have a audio feed in there, so you can actually listen to them and talk to them on the audio feed. And that comes with it as well. Plus, I have about 30 wise-weighted trade options in the video library. And as I said, every strategy that we have, including the SPY Super System, has a pretty really detailed videos on them. The SPY Super System videos is about 35 minutes or so. Now, if you sign up today, by Sunday, the first 10 will get a 2-week free trial. You can come in and try it for 2 weeks. It's not very long for the alert service. 2 weeks in the room is pretty good. You'll get to see a lot in 2 weeks for the room. All right, and the sale, of course, ends on Sunday. For the lifetime, what is a lifetime included? It includes the alert service forever. For as long as the alert service goes on, you just keep getting alerts all the time. And you get the Discord room too. All right, so now the trading room itself, again, we have a 50% off sale on this. You get a year for just $11.98. If you want to try it for a month, you can try it for $148. I don't think that's long enough to really make a judgment, but it's up to you. But the yearly is pretty nice for $11.98 because that's, well, you saw what the results were. So, and if you're in the room, you're getting all the SPY Super System trades that occur. I'm at least pointing them out, and you can take them yourself if you're in there. All right, and you'll get the videos, the wise-weighted trade options on the videos, about 30 of them. So again, so that's the room. And then the last one is the Compass options. This is the Compass trading system. This is the system itself. This is $14.98 for a year and $19.98 for lifetime. That means you get the software and you keep it forever. It's going to look exactly the same as my Compass system. It comes. I have a bunch of scanners that comes in the Compass system that I have up and running all the time. If you're in the room, you'll see them. I'll show them to you at the end here. And obviously, you get a month in the live. You get a month in the live trading room as well if you buy the Compass system. They will install it on you for you. The Rightline folks will actually take over your machine, install it on your Thinkorswim platform. If you don't have Thinkorswim, you can download it and they'll install it on there for you. It'll look exactly like my setup. All the indicators, all the scanners, everything that I put in there. Again, you'll get the Discord chat and you'll get the SMS alert services for the time as well. So those are the three things. Again, you'll get my workspace, and I'll show you what the Compass system looks like. Let me just do that right now. Okay, so this is the Compass system right now. This is what it looks like if you're in the room. This is what I have displayed all the time. These are the scanners. There's two scanners, right? I have a bunch of different scanners, but the ones I had running, I have a cascading up scan and a cascading down scan. These are on 5-minute basis. So when the market's going down, I'll run the cascading up scan. Anything that's cascading up when the market's going down has got relative strength. In the cascading down, when the market's going up, cascading down stocks will show me every stock that's got relative weakness against the market. So one of those criteria is then picked up. All right, and then this is why I have new yearly highs, but I have several other scanners in here. If I just pop here, you're gonna see I have a bunch of different scanners that I can put up for different conditions. And you'll get all the scanners that I have. But those are the ones that I've got there running are the main ones. One thing that's nice about these scanners, if I click on the tab, the stock over here, it brings the chart right back up. There's JetBlue on a 5-minute chart, IONQ on a 5-minute chart, LI. If I like it, for example, on the 5-minute chart, I can switch over the daily chart and I can see what it looks like on the daily chart. Here's the daily chart, nice little breakout. See that we've gone to blue and green here on JetBlue, pretty bullish. So that's what it looks like. And again, this is what you would get if you get the Compass system. They're gonna install it with all of the criteria, all of the indicators that I have on here, as well as the scanners. All right. So that's about what I've got to cover here today. Again, if you have any questions, you can chat with Rory. Send him just put your name and number in there, and he'll cover it for you. Again, you've got the alert service, $396 for a quarter, $992 for a year, and $24.96 for lifetime. Let me see. I think he's got the in the chat box. Yeah, he's got all the links in the chat box for the 3 different offers that we've got here. So if you want to take advantage of that, you can click on there, or you can just call him and talk to him about it, and he'll answer any questions you've got. But I think that the pricing is really great considering I've showed you what the results are. And if you're in the room, you'll get the SPY Super System. We talk about it in there. I'll show you setups as they occur. If you have the Compass system and you're not in the room, then you can look at my video and learn how to do the SPY Super System yourself. A lot of people like trading those things. So again, there's your 3 offers: the Compass trading system, the trading room, and the alert service. And again, the links are in the chat box. All right. So the system indicators only work on TOS platform. They also work on Ninja 8. They'll work on Ninja 8. Now they look different on Ninja 8. Ninja is basically a platform to trade futures. I mean, that's what most people trade on there. But you can trade it. This system will go on Ninja. It's called the Money Flow Tracker on Ninja, the Money Flow Tracker, and that'll give you the same indicators, the same information that I have over here. So it looks a little bit differently, and I don't use Ninja for my day trading. So I use TOS because I like the setup better, and I can do stocks. I can trade relative strength and relative weakness on stocks. So that gives me trading relative strength and relative weakness gives you an additional edge over trading like futures. All right. So I think that wraps it up. I thank everybody for being here today. I really appreciate everybody spending so much time here with me. It ran about an hour and a half. So, but I had some great questions, and I really appreciate everybody's taking this Saturday here. You have the Money Flow Tracker. Will it work for this on TOS? Will it work? Well, you have to put the compass system on TOS. Money Flow Tracker doesn't run on TOS. I mean, it's the Money Flow Tracker is created for Ninja, which is complete. It uses different criteria. All right, so yeah, you can, if you want to trade futures, you can trade futures with Money Flow Tracker on the Ninja platform, and it'll give you the same indicators that I have with the compass, but I don't do the SPY Super System over there. Although you can use the SPY Super System on compass to trade futures as well, because the criteria I've got there is set up for the compass system on TOS. All right, everybody. Well, listen, thanks so much for being here today. I really appreciate you taking part of your Saturday. I hope it was helpful. I hope the option portions helped you a little bit, and look forward to seeing some folks in the room and on the alert service come next week. So have a great weekend, everybody. We'll see everybody on Monday.